All right, NVIDIA. What do you think about SPY over the next few months? Good question, Paul. My thoughts on SPY over the next few months are that we are just in such a slow, steady uptrend. Like these are very small ranges up and down. A very slow, steady uptrend. I think SPY is way overextended. I don't have it on this chart, but I've gone over it quite a few times in this stream before. Let me show you something really quick. I need to get 2008 involved. Okay. A rough trend line on SPY looks like this. And this is how I predicted before COVID, the exact drop of 34% in SPY. I bought a ton of puts in SPY in December and January, right before COVID. So December 2019, January 2020, right here. I bought a ton of puts because I saw I was getting overextended. And then I held on all the way down here because I had this trend line drawn in. So this trend line shows, this is like a mean line, like an average line. This is the average true value kind of thing. This is called the value line. This type of trend line that you draw through a chart, not necessarily a trend at the bottom connecting all the lows, but it goes through it and connects the lows and the highs. And what this shows you is in this period, we were above the value line. The stock market was overvalued. And then the 2007, 2008 crash happened and we became undervalued. And it took until 2013 to recover to the previous high, as well as get back to the value line. And then after that, we're overvalued. You can see we come down and test it. Whoops. We come down and test it. And then we come up and we get so overextended here. Like, look how overextended we are here, and then come back down. And then look how overextended we got here. Tried to come back down. This was early 2019. You guys remember end of 2018. We have Bitcoin crashing, lots of stuff going on. But no, we recover that, and then we get even more overextended. Come all the way up here, and this is where I'm seeing this inverted hammer on the monthly. There are some weekly patterns as well. I'm seeing this get overextended and breaking some lows. And there's a level, it was like 320 or 325 or something. That was my trigger to get in to puts. Held this all the way down to the bottom to touch that value level. And now we are this overextended from the value level. So before the 2008 crash, when we were in a bubble, this is what that bubble looked like. If you come all the way back, this is what the .com bubble looked like, right? Compared to this. This is over just about 100% increase, a 100% bubble, double the value at the value line. And so for the market to come back down to earth, so to speak, the whole what goes up must come down mentality, which isn't always true in the stock market. You know, I have this video on Instagram where I say the three lies in the stock market. One of them is what goes up must come down. I say, no, what goes up might go up again. What goes up might go up again. And that's true. But at some point, there will be some sort of crash, and that's what we thought this was, but it recovered way too fast. This was just a V-shaped recovery. It pretty much didn't exist, but close to 100% off of this value level is insane. 100% off of the COVID lows, 218, we are 100% off of the COVID lows at the high of the market. So I think the market is extremely overextended, but there is no sign right now of this changing. Now we could enter a new paradigm of stocks where this value level that we've used for the past 20 years becomes pointless. We could. Maybe we're in this new era, this new post-COVID era, this post-Donald Trump era, where the market is just perceived as something different now. Instead of being a slow exchange of money, now it's retail traders. And we get into the whole retail trader market, where this might be the value level. Something along the lines of, here, let me draw it in. Something along the lines of this. Maybe this is the value level, right? And so we were overextended, barely ranged below the value level, and now we bounced off of it here, And now we're getting overextended, yes, but maybe this is the new value level in this retail trader era, this stunk value level, exactly, whale. So that's my brief thoughts on SPY. I think it's overextended, but there's nothing that's giving this red flag alert, massive crashing coming, other than the fact that we're in somewhat of a bubble and we are somewhat overextended. And investors and traders of the likes of Warren Buffett and Ray Dalio have both posted on different social media platforms and different journalism platforms about this bubble and how this bubble is close to being as severe as, or significantly more severe than the dot-com bubble and that boom and crash. So there's a lot of analysis out there, and it's pretty much at this point where nobody knows exactly what's going on. But then again, in the dot-com era, we didn't know exactly what was going on either. Until after the fact, we research it and we see, that's what happened. And that's probably going to be the same situation. Now, Ray Dalio is famed for finding patterns in past things and then using those patterns for future situations that are eerily similar. And so I forget exactly, I read it a while ago, but his analysis is that essentially the bubble we are in is real, but it looks on the outset to be more severe than the dot-com bubble, but in reality it's not. I forget the exact details, so don't quote me on that. My analysis of it is we are entering a new era of trading, with retail trading and online trading becoming insanely popular, and I think that's changing the paradigm. So while the market is still overextended, we might be overextended in a new way, which makes it less severe. But we won't know till after the fact, really. And we just keep watching every day, every week, every month, every year to see if there's any signs of a downturn, like when I bought puts and shorted the market in December of 2019. So that's my analysis of SPY.